Hey everyone and welcome. Ever notice how the price of your favorite snack, a tank of gas, or even your rent seems to creep up over time? Well, today we're diving into the economic term that explains this phenomenon, inflation. In simple terms, inflation is the general increase in the prices of goods and services in an economy over a period of time. It means that for the same amount of money, you can buy less stuff than you could before. Think of it like your money losing a little bit of its purchasing power over time. Now, inflation isn't about the price of just one thing going up. That could be due to specific supply and demand for that item. Inflation is a broader trend affecting most goods and services in the economy. So what actually causes these prices to rise? There are a few key culprits. First, we have demand pull inflation. Imagine everyone suddenly wants to buy the latest gadget. If the companies making that gadget can't produce enough to meet the demand, they can start charging more because people are willing to pay. It's like a tug of war where high demand pulls prices up. Next up is cost push inflation. This happens when the cost of producing goods and services goes up. Think about the price of oil. If oil prices surge, it becomes more expensive to transport goods, manufacture products, and even power our homes. These increased costs can then be pushed onto consumers in the form of higher prices. Another important factor is inflationary expectations. If people expect prices to keep rising, they might ask for higher wages to keep up. Businesses, in turn, might raise their prices in anticipation of these higher labor costs. It's a bit of a self-fulfilling prophecy. Finally, the amount of money circulating in the economy plays a crucial role. If there's too much money chasing the same amount of goods and services, the value of each unit of money decreases, leading to higher prices. This is often related to the actions of the central bank. Now, is a little bit of inflation always bad? Not necessarily. A low and stable level of inflation is often seen as a sign of a healthy, growing economy. It can encourage spending and investment. However, high or uncontrolled inflation can be really harmful. High inflation can make it difficult for people to afford basic necessities, erode the value of savings, and create uncertainty for businesses, potentially hindering economic growth. So, to recap, inflation is the general increase in prices, meaning your money buys less over time. It can be caused by high demand, rising production costs, expectations of future price increases, and the amount of money in circulation. While a little inflation is normal, high inflation can have negative consequences for everyone.